Good day, fellow investors. Warren Buffett has $382 billion in cash, and if that isn't warning enough, I don't know what is. Berkshire's earnings are out, so we'll discuss the key topic here. Is it better to be in cash than invested? The way Warren Buffett is looking for opportunities with the Oxychem example, a little bit of earnings, and then the Berkshire stock valuation. But let's immediately start with the cash. $381.7 billion, all invested in US Treasury bills, usually 3 months of average, giving around 4% annual yield. If we look at the pile, of course, when Berkshire was small, he also had some cash. Then before the global financial crisis, he was very prescient on those declines. A little bit before the 2020 almost recession, and now after the market boomed, he is totally in cash. And he has more cash, Berkshire Buffett, than the stock market portfolio everyone is so focused on. As said, that is yielding around 4%, depending on the averages, now a little bit less with the Fed cutting. However, that should bring in 15 billion over the next 12 months. But as always, Warren Buffett says that when you have nothing to buy, cash is best. And that is because every indicator of the stock market tells us this is a huge bubble. The Buffett indicator, US stock market value to GDP, is at extreme highs, above 200%. Buffett says that when the stock market is above 120% of GDP, things are crazy. And things were crazy during the dot-com bubble. Now that's craziness on steroids. Another Buffett indicator is profit margins that are now at a staggering operating profit margins, 13.6%. Buffett says that profit margins on average will be around 8%. Which means the government can increase taxes. Somebody will yell, okay, this is not okay, that businesses make so much money on us. And you can see here how profit margins used to be in the 6 to 8 range when things were still a little bit normal. And now we are at 14 to 12. These great charts, Yardeni research. If just that, everything else remains the same, and just profit margins normalize, that's 1/4 of the stock market down. But Sven, stocks look so good now. Why do you and Warren want to ruin the party? Well, if we even look at the cyclically adjusted Shiller ratio, it's at 40. The highest historical was 44. It was even 4. And we have seen these peaks already. Everybody knows how the story ended, but maybe this time is different. Plus, this is the cyclically adjusted Shiller P ratio, which means it takes into account recessions, but we haven't had a recession for the last 15 years. Thus, those are earnings on steroids. And on top of everything, earnings are expected to grow at 10-13% going forward, even if they will usually historically grow 2% plus inflation. Therefore, earnings are not sustainable, and all this exuberance in business in this might lead to taxes down the road, because that is also a cycle. Taxes on big businesses. Warren Buffett always has this long-term view, not on what's going on now, but on what might be going on over the next 5, 10, 15 years. It is pretty clear that the US debt is unsustainable, so you are borrowing like crazy. 27% of sources of financing of the government is borrowed. The interest rates payments are 14% of spending, which is completely unsustainable. And while this is all paid by the normal American, the rich with 13% profit margins have their weddings in Venice. This is pictures I made because Jeff Bezos has 2 boats. This is the sailing boat, and then you can't get a chopper here, so he has this other boat next to the one. Why did I make this picture? Because they were getting married here in Venice and I live across the sea, and they couldn't anchor here, so they had to do that here. Anyway, that are the key long-term developments. It's clear that things are unsustainable, that it is a Ponzi scheme. And then we have Goldman CEO saying how there is a debt reckoning coming if growth flags. And then if I look at the details there, the path out is a growth path and low chance of a recession near term. Growth, which means more debt, of course. Why does Goldman Sachs CEO want more debt, more money, more deals, more growth? Because that's how he makes money, and if it doesn't work, well, Warren Buffett will bail him out, or perhaps the government. Look how great, how smart we are. We didn't go bankrupt like Lehman Brothers in the last crisis. So I don't know whether Goldman will be right or not, and maybe one day Americans will wake up, the ones not in the top 10%, and say, hey, here's something not okay. And that's also something that Warren Buffett might be thinking. Because when you see the market at 10x here in the last 15 years, how much more growth can you aspire for? And then you say, okay, if everything is so overvalued, what to buy? You might have only millions compared to Warren Buffett's billions, so let's check if there is something available for us with peanuts. And a great indication of what's going on can be Berkshire's OxyChem deal. 10 billion paid, but this is pure Warren Buffett, and this is exactly what Warren is now waiting for. If you look at OxyChem's current pre-tax income, it is just shy of 10 billion, so Warren Buffett paid 10 times pre-tax income. However, when did he pay that? In a cyclical downturn. That's where he bought the cash flows. Perhaps 3-4 years from now, this will be a 2 billion return, and that is how Warren Buffett does things. And 10% yield plus growth is better than cash. We'll do tomorrow our quadrant update. We'll eliminate some of this. There are 10% potentials, so you can see tomorrow what can fit your portfolio. Also, check my research platform. Yesterday I made a sales pitch for it because I truly think now is the time to really build a value investing pillar based on fundamentals for your long-term wealth accumulation strategy. And the value, there is still value in some small pockets, but most is very risky. Now, let's discuss Berkshire's great earnings. If we look at the earnings, insurance underwriting has done really well. However, always keep in mind, Warren Buffett doesn't expect to make a profit on insurance. Simply means no catastrophes, no nothing. But he hopes to be at zero there and enjoy the benefits of the float invested in stocks. All in all, the last 9 months, 34 billion, and we can expect that on average, Berkshire will make 45 billion in net income over time. Now, how to value this? We must keep in mind 14 billion there is from net income on the cash. So you can value Berkshire at 30 billion in profits times, let's say, an average P ratio of 15, which is 450 billion, plus around 300 billion in cash, because the 50-70 billion is there set for potential insurance disasters. And if I sum that up, the intrinsic value of Berkshire for a good 7 to 10% return for investors is around 750 billion. The current market capitalization is 1.3 trillion, which means Berkshire is overvalued, and I keep telling people it is a great business, one of the best business, potentially one of the best investments you can ever make, because all the bitcoins and things like that will go to zero. There is no business risk, it will keep on compounding, but now it is pricey. Because the P ratio is in the 20s, and usually it's better to buy closer to the 10s. Does that sound crazy? Well, this is a video from 5 years ago when I told you Berkshire is offering 10% forever. And you can see here, that was one opportunity, of course, in March 2020. However, Even now, I think that Berkshire is better than the S&P 500 because the separation will come due to the cash. And if you look at the performance here, pretty equal performance depending on the starting point over the last 5 years. You cannot really look at that. However, we see here something. When stocks were going down on Liberation Day, Berkshire was going up. When stocks go up, Berkshire is going a little bit down because it's not promising plus 40% growth that Nvidia is promising. However, the same thing happened in 1998, 2000, minus 50% for Berkshire because Warren Buffett was old. Now again, he's going to cash. However, at that moment, the Nasdaq crashed 77% after that. Berkshire went up 2x and the rest is history. Berkshire is a hedge now, but there are no buybacks because it's too expensive for Warren Buffett. So if you really want to patiently wait for an opportunity to buy Berkshire at a fair price, wait for recessions, I don't know, insurance disasters, hopefully not, things that are ugly, and then you can find it cheaper. The key is that this is a long-term compounding machine that you can buy at whatever price, you will do okay. But if you can buy it a little bit cheaper, that's true value. I would say that now it is fairly priced. They cannot find that many deals. So how long are you going to wait with your cash, or you're going to look for 10% smaller opportunities? And we also don't know for how long Warren Buffett is going to wait. But that is value investing. 4% treasuries is better than the S&P 500, Nasdaq, private equity, whatever. And why? Well, the performance over the last 50 years tells you why. Maybe we'll have a crash only in 5, 7, 8 years, but Buffett doesn't want to risk the long-term compounding. He has done so greatly over the last 50 years. Will there be a crash? Is it better to be in cash? See what makes you sleep better at night. Also, check my research platform for a potential hedge.